Imagine a company that just suddenly decides to slash the price of its core product by 40%.
Right.
Your immediate instinct, especially as a retail investor, is just absolute panic.
Oh, totally. You think they're racing to the bottom?
Exactly. You assume their margins are collapsing, the business model is, in a death spiral.
Yeah, that it's a desperation move.
Right. But what if I told you that by charging 40% less, this specific company is actually making the exact same amount of profit per customer?
It sounds impossible.
It does. It's a paradox. And the mechanics behind that paradox are exactly what we're unpacking today. So, welcome to a special Talk Tickers edition of the Deep Dive.
Glad to be here.
Today, we are opening the hood on Laureate Education. The ticker symbol is LAUR. And we have the official Q2 2026 earnings call transcript right in front of us.
Featuring the CEO, Eilif Serck-Hanssen, and their CFO, Rick Biskirk.
Yeah, and our objective, as always on this show, is to translate all that corporate Wall Street reporting into an actionable, heavily opinionated bottom line for you, the retail investor.
Because, look, the broader context here is that earnings calls are notoriously opaque, right?
Oh, completely.
They're designed by these corporate communications teams to manage institutional expectations. They bury the actual fundamental drivers of the business under layers of accounting jargon.
The Wall Street gatekeeping.
Exactly, the gatekeeping. And our mandate today is to strip all that away. We're going to look at the raw data, analyze the strategic engine driving the numbers, evaluate management's forward guidance, and ultimately determine if Laureate's current market position is a buy, a hold, or a fold.
Okay, let's unpack this. Let's start with the foundation, which is the Q2 headline numbers.
Yeah.
Because the data forward top line here is pretty striking.
It really is.
For just a single 3-month period, Laureate reported revenue of $616 million.
Which is massive for a quarter.
Right. And adjusted earnings per share, or EPS, hit $1 even. But the metric that really caught my attention wasn't just the money. It was the human element behind that capital.
The enrollment numbers.
Yeah. Year-to-date new enrollments are up 10%. And that pushes their total student body to approximately 507,700 students.
Which, I mean, we need to contextualize that scale for a second.
Please. Because 500,000 students is hard to wrap your head around.
It is. If you look at the traditional higher education landscape here in the United States, a massive state institution, think like the Ohio State University or Texas A&M.
Right. Huge football schools.
Right. Massive physical footprints. They operate with roughly, 60 to 70,000 students.
Wow. Okay.
So Laureate is managing a combined academic population that is effectively 8 times the size of the largest physical campuses we usually think of.
That's insane.
It is. The logistical, the technological, and just the administrative architecture required to successfully process tuition, deliver the curriculum, and maintain accreditation for over 500,000 active learners. It's just a staggering operational achievement.
It really recontextualizes that $616 million revenue figure. Because when you're managing a population the size of, a medium-sized American city, the cash flow generation has to be enormous just to keep the lights on.
Just to maintain equilibrium, yeah.
Right. And that brings us to their profitability. So for Q2, they reported an adjusted EBITDA of $251 million.
Which is a very healthy margin.
Yeah, but I want to unpack the specific language management used around these figures, because they repeatedly emphasized on the call that both revenue and EBITDA grew by 8% on a, quote, constant currency basis.
Yes, constant currency. That's a crucial term here.
Right. And I want to proffer an analogy here just to see if I'm reading the mechanics of this right.
Please do. Go for it.
So I look at constant currency kind of the way I look at evaluating the engine power of a cargo ship.
Okay, I'm with you.
If a ship is traveling downriver, right,
Yeah.
and there's a massive rushing current pushing it from behind, the GPS might say it's moving at 20 knots.
But the engine isn't working that hard.
Exactly. The engine isn't actually generating 20 knots of speed. The river's doing half the work.
Right.
And conversely, if that same ship turns around and fights its way upriver against that current, the GPS might say it's only moving at 8 knots. But the engine might be working at maximum capacity, burning fuel like crazy.
Just fighting the water.
Exactly. So if you, as an investor, are buying that shipping company, you don't really care about the river's speed. The river's totally out of your control.
You want to know the true horsepower of the actual engine.
Right. You want the isolated horsepower. So when Laureate talks about constant currency, they're essentially factoring out the macroeconomic river, which is the foreign exchange rates, to show us the true horsepower of their core operations.
That framework actually perfectly captures the dynamic because Laureate's engine, as you put it, is entirely located in Latin America.
Specifically Mexico and Peru, right?
Right. So their customers, the students, they pay their tuition in Mexican pesos and Peruvian soles.
Okay.
However, because Laureate is a publicly traded entity listed on a U.S. exchange, the SEC requires them to report their financial performance in U.S. dollars.
Right, they have to translate it back for Wall Street.
Exactly. And the exchange rate between the dollar and the peso, or the sol, it fluctuates continuously. It's based on geopolitical events, central bank interest rates, global inflation data.
Those are the river currents in your analogy.
Precisely. Those are the currents.
Meaning, if the U.S. Federal Reserve suddenly hikes interest rates, the dollar strengthens globally.
Yep.
And suddenly, the Mexican pesos that Laureate collected are worth fewer dollars on paper, even if Laureate enrolled record numbers of students that quarter.
Which is the core distortion that Wall Street analysts have to manually remove. Because if we only looked at the reported unadjusted dollar amounts, we might falsely conclude that Laureate's business is shrinking during a period of dollar strength.
When really it's just an accounting illusion.
Exactly. By utilizing the constant currency metric, management isolates the operational variables they actually control. How many students they enrolled, how much tuition they charged, and how efficiently they ran their digital infrastructure.
And on that isolated operational basis, their revenue and their adjusted EBITDA both grew by 8%.
Which tells us the underlying business is accelerating.
It is. I want to linger on that adjusted EBITDA figure for a moment too. The $251 million. Because for anyone tracking their own portfolio, EBITDA is a metric you see everywhere.
Earnings before interest, taxes, depreciation, and amortization.
Right. It's a mouthful. But I tend to view adjusted EBITDA simply as the unvarnished operating truth of the company.
That's a good way to put it.
It basically measures the cash generated purely from doing the thing the company exists to do before the capital structure, the debt obligations, or the tax accountants get involved.
It separates the business model from the financial engineering.
Right.
Two competing education companies could have the exact same curriculum, the exact same student count, and the exact same revenue.
Right.
But if Company A took out massive high-interest bank loans to build their campuses, their final net income will look terrible compared to Company B, which funded its growth through its own cash flow.
Because Company A is drowning in interest payments.
Right. So adjusted EBITDA allows an investor to look past the debt structure and ask, does this specific method of selling education actually generate a surplus?
And at $251 million of adjusted EBITDA for a single quarter, Laureate's model clearly generates a massive operational surplus.
Unquestionably.
Which naturally begs the question of how they're generating that surplus.
Right.
Because these headline numbers, they're merely lagging indicators. They just tell us what happened over the last 3 months.
Right, they look backward.
To determine if this stock is actionable for you, the listener, we have to isolate the leading indicators. We need to dissect the growth engine itself. And, based on reading this transcript, that engine is not built on pouring concrete for new physical lecture halls.
Not at all. It is entirely predicated on highly targeted digital scaling.
Here's where it gets really interesting.
The strategic pivot management has executed here is fascinating because when the average retail investor hears the phrase online university, the immediate mental image is usually a 19-year-old taking intro courses on a laptop in their childhood bedroom.
Yeah, totally.
But Laureate has completely bypassed that demographic for their digital expansion. They have engineered fully online degree programs that are explicitly designed for and marketed to working adults.
We're talking about a demographic cluster between the ages of 25 and 50.
Exactly.
People who are already entrenched in the workforce. They have full-time jobs. They likely have families. They have mortgages.
They are profoundly time poor.
That's the key, right? The time poverty.
It's the defining characteristic of this consumer base. Like a 35-year-old middle manager in Mexico City simply cannot pause their career to attend in-person classes at a traditional campus on a Tuesday morning.
It's physically impossible.
Right. They require absolute temporal flexibility. And Laureate has recognized the massive scale of this unmet need. According to the Q2 transcript, in Mexico alone, they currently have 90,000 students enrolled in these fully online working adult programs.
90,000.
Yes. And furthermore, that specific demographic segment is growing at high single-digit rates.
I mean, 90,000 online students in a single country is a staggering achievement in market penetration. That is effectively a massive top-tier university operating entirely in the cloud.
It is. Yet the dynamic in Peru is arguably even more compelling from an investor perspective.
Really? Why is that?
Well, the transcript notes they have 25,000 fully online working adult students in Peru. Now, at first glance, 25,000 seems a lot less impressive than 90,000.
Sure, it's a fraction of the size.
However, management provided a crucial piece of context here. That 25,000 student cohort represents a total market penetration rate of less than 5% in the Peruvian market.
Less than 5%.
Yeah.
So the total addressable market is still almost entirely untapped.
The headroom for expansion is just massive. Management is treating the Peruvian digital market as being in its absolute infancy compared to the maturity they've achieved in Mexico.
Got it.
They anticipate the growth rate in Peru to aggressively outpace Mexico in the coming years, simply because the baseline is so incredibly low and the demand is so high.
So they've identified this time-poor, older demographic and built a digital product specifically for them. And this brings us back to the paradox I introduced at the very beginning of the show.
The pricing structure.
Right. I call this the margin magic.
Yeah.
According to CEO Serck-Hanssen, these fully online programs for working adults are priced 40% below Laureate's traditional face-to-face campus programs.
Right, which is a structural discount of a magnitude that completely alters the value proposition for the consumer.
Oh, totally.
If a traditional 4-year physical degree program costs the equivalent of, say, $10,000, the online version is priced at $6,000.
Which is huge.
For a working adult trying to upskill without taking on ruinous debt, that price elasticity is a massive demand trigger.
But the demand trigger is only half the equation, right? Because the immediate friction point for an investor analyzing this model is the assumption that a 40% price cut destroys the profitability of the unit economics.
You'd assume they are trading margin for volume.
Exactly. You think, okay, they're selling it cheaper, they must be making less per student, but making it up in bulk. But the earnings call revealed the exact opposite.
This is where it gets really brilliant.
Despite the 40% discount to the student, Laureate's contribution margin, which is the actual profit realized on each individual student, after direct educational costs are subtracted, it sits securely in the mid-50% range.
The critical detail being that a mid-50% contribution margin is virtually identical to the margin they achieve on a younger student paying full price at a physical campus.
And this is the mechanism I want to dissect deeply for a minute. Because how is it structurally possible to reduce top-line revenue per unit by 40% and maintain the exact same percentage of profit?
It seems like accounting magic.
Right. But my read on this comes down entirely to capital expenditures, or CapEx.
The physics of physical real estate versus the scalability of cloud architecture?
Exactly. Let's follow the money on a physical student. If Laureate wants to add 500 new 18-year-old students to a campus in Monterrey, Mexico, they can't just snap their fingers.
No, they have to acquire land.
They have to pour concrete. They have to build lecture halls, install plumbing, route electricity, establish secure Wi-Fi networks across the campus, and pave parking lots.
And the capital allocation doesn't stop once the ribbon is cut, right? Physical infrastructure requires perpetual operational expenditure.
Yeah, the ongoing costs.
You have to pay groundskeepers, security personnel, HVAC maintenance teams, and facilities management. The upfront capital investment is massive, and the ongoing depreciation of those physical assets is just a constant drag on the balance sheet.
Right. Conversely, let's look at adding 500 working adult students to the fully online program. The CapEx requirement is effectively zero.
Right.
Laureate does not need a single new brick or a single new parking space. They simply need to increase their cloud server capacity on AWS or Azure, which costs, pennies on the dollar, and grant some more software licenses for the learning management system.
The marginal cost of adding one more digital student approaches zero.
It's basically free for them to add the next student.
Exactly. Therefore, even though Laureate is only collecting 60 cents on the dollar compared to a physical campus student, the cost to deliver that education has plummeted by an even greater margin.
Wow.
And the financial metric that captures this dynamic perfectly is return on invested capital, or ROIC.
Because the denominator in that equation, the invested capital, is drastically minimized in a digital model.
Precisely. For every $1 million Laureate invests in expanding its digital footprint, maybe upgrading its user interface or licensing new video software, The profit it returns is wildly disproportionate compared to investing that same $1 million into pouring a concrete foundation for a new library.
The ROI is just on another level.
The ROIC on the digital business is astronomical, and that pulls the consolidated margins of the entire company upward as that specific segment grows.
Okay, I have to introduce some heavy friction here, though.
Bring it on.
Because as an analyst, when I see a company offering two versions of the exact same product, one at a premium price and one at a 40% discount, I immediately look for structural cannibalization.
The obvious risk, yeah.
If the ultimate credential on the diploma is identical, why wouldn't this aggressive digital pricing strategy absolutely cannibalize their highly profitable legacy campus enrollments? I mean, if I am a smart 20-year-old in Mexico City, why would I ever pay the premium for the physical campus when I can just take the 40% discount, study from my apartment, and secure the exact same degree?
It's a fair question.
If this trend accelerates, won't Laureate eventually destroy its own top-line revenue as the entire student body migrates to the cheaper option?
So the cannibalization thesis is probably the most common bearish argument against Laureate's strategy. And actually, it was a primary focus of the analyst Q&A during the earnings call itself.
They were asking about this.
Heavily. But management's defense against this risk is remarkably robust. And it relies on extremely disciplined, intentional market segmentation. They are not allowing the two consumer bases to overlap.
So they're essentially building a walled garden based on age and life circumstance.
The sociological reality of education actually dictates this strategy for them.
What do you mean?
Well, management possesses deep internal data showing that a fully online, asynchronous degree program is fundamentally incompatible with the psychological and developmental needs of the average 18 to 22-year-old.
Oh, that makes sense.
Right. When a young adult transitions out of high school, they require the structural scaffolding that a physical campus provides. They need in-person socialization, peer networking, direct mentorship from professors, and just the rigid schedule of physical attendance to remain accountable.
Because if you isolate an 18-year-old in their bedroom with a laptop and a syllabus, the friction of self-direction becomes overwhelming.
And they just log off. The attrition data supports that entirely.
Yeah.
The dropout rate for traditional age students placed exclusively in fully online environments is disastrously high.
So they just fail out.
Yes. Management recognizes that if they allow the younger demographic to cannibalize the cheap online offering, they won't just lose the premium tuition revenue, they will lose the student entirely to attrition.
So the strategy is active prevention. Laureate intentionally restricts the marketing of the cheaper online degrees exclusively to the older working adult cohort.
Exactly. The physical campus experience is aggressively marketed to high schools and younger demographics. The transcript highlights a fascinating data point, actually. Over 95% of Laureate's younger students who reside within commuting distance of a physical campus are actively enrolled in that physical campus.
95%. So it's working.
The cheaper digital product is strictly ring-fenced for the 25 to 50-year-olds.
Because for that older demographic, the choice isn't between the premium campus degree and the cheap online degree.
No.
The choice is between the online degree and no degree at all.
It is a completely non-competing consumer base. The digital product captures a massive, historically underserved market of working professionals who were previously locked out of higher education entirely due to cost and schedule constraints.
Wow.
And CEO Serck-Hanssen actually invoked a highly relevant cautionary tale during the call to prove they understand the stakes here. He pointed to the education sector in Brazil.
Let's explore that comparison, because I saw that in the transcript too. What exactly went wrong in the Brazilian market?
So several years ago, certain Brazilian education operators attempted the exact maneuver you feared. They chased volume at the expense of segmentation.
Okay.
They conditioned their entire consumer base to believe that if you couldn't easily afford a premium physical degree, you should just enroll in the heavily discounted online alternative, completely agnostic of the student's age or developmental readiness.
They erased the walled garden.
Completely erased it. And the results were catastrophic for the sector.
What happened?
It led to massive institutional overcapacity, plummeting academic outcomes, horrific retention rates among the younger students, and eventually intense regulatory scrutiny from the government trying to clean up the mess.
Because everyone was failing out.
Right. Laureate's management team is explicitly citing the Brazilian collapse as their anti-model.
They're saying, we will not do that.
Exactly. By strictly enforcing demographic boundaries based on the distinct sociological needs of the student, they protect the premium revenue of the physical campuses while simultaneously scaling the high-margin digital business into the adult market.
So the discipline to turn down revenue from a 19-year-old who wants the cheap online degree is what ultimately protects the long-term viability of the business model.
Yes.
Now, executing that level of granular segmented marketing, identifying the exact 35-year-old working professional who is primed to return to school in a nation of 135 million people like Mexico that requires computational capabilities far beyond traditional advertising.
Oh, absolutely.
And this introduces the next major operational catalyst discussed on the call, the integration of artificial intelligence.
And this AI narrative within Laureate is not merely forward-looking speculation. It's not just buzzwords for investors. It is currently embedded in their operational architecture.
The level of confidence CEO Serck-Hanssen projected regarding their AI capabilities was striking.
It was.
He noted on the call that Laureate has been formally recognized by both Google and the Boston Consulting Group, BCG, as operating in the top decile globally for AI digital marketing capabilities.
The top decile.
I mean, to be audited by Google and placed in the top 10% of all organizations utilizing their digital tools, that is a massive validator of their internal tech stack.
It really shifts the perception of Laureate from a traditional education provider to an education technology hybrid.
Right.
Because when management discusses AI, digital marketing, they are referring to the deployment of highly sophisticated predictive algorithms designed to optimize lead generation.
Okay, unpack that a bit.
Well, historically, university marketing relied on broad-based, low-efficiency tactics. Billboards on the highway, television spots, generalized digital banners.
A spray-and-pray methodology. You spend millions of dollars hoping the right demographic happens to see the advertisement at the exact moment they are considering getting a degree.
Which results in an incredibly high customer acquisition cost, or CAC.
Right, because you waste so much money on people who don't care.
Exactly. Laureate is utilizing AI to completely invert that model. Their predictive models ingest massive amounts of behavioral data to identify high-probability prospects.
It's precision targeting.
Hyper-precision. The algorithm determines not only which working adult is statistically most likely to enroll, but also calculates the specific messaging framework that will resonate with their unique career anxieties.
Wow.
And then it pinpoints the exact time of day and digital platform where delivering that message will yield the lowest possible acquisition cost.
They have transitioned from broadcasting to narrowcasting. It is the application of advanced behavioral economics to student recruitment.
It really is.
But, the integration of AI doesn't stop at the top of the funnel. CFO Rick Buskirk elaborated on how they are deploying AI to solve the single greatest threat to the digital business model, which we touched on earlier, student attrition.
Retention is everything.
He detailed their ongoing rollout of an AI tutor.
And this represents a profound shift in the pedagogy of online education, because the structural vulnerability of asynchronous digital learning is the absence of immediate academic support.
All right.
Consider the environment of the adult learner we talked about earlier. A 35-year-old parent works a 10-hour shift, puts their children to sleep, and logs onto their learning portal at midnight to study corporate finance.
Their cognitive load is already completely maximized. They're exhausted.
Extremely. And then they hit a friction point. They encounter a complex mathematical concept they just do not understand.
And because it's midnight, there is no human professor available to email or call.
Right. The traditional online model leaves that student completely stranded. Frustration compounds, the feeling of isolation sets in, and that midnight friction point becomes the exact moment they decide to drop out of the program.
The safety net simply doesn't exist.
Exactly. But by integrating a sophisticated AI tutor directly into the learning management system, Laureate creates a 247 instantaneous safety net.
So it's not just a chatbot.
No, it's way beyond that. When that working adult gets stuck on the finance equation at midnight, the AI tutor intervenes. It doesn't just provide the answer, it dynamically adjusts the student's learning pace, walks them through the conceptual framework, and clears the friction point in real time.
The economic implications of that intervention are massive.
Huge.
Because keeping an existing student enrolled is exponentially cheaper than deploying marketing capital to acquire a brand new student to replace them.
The lifetime value, or LTV, of the student drastically increases, and management explicitly reported on the call that they were already seeing.
Synthesizing these operational components provides a very clear picture of the company's internal health. You have a massive structural pricing advantage driving volume. You have near zero CapEx maintaining premium margins. You have a disciplined walled garden protecting the legacy campus revenue. And you have AI algorithms mathematically optimizing both acquisition and retention.
It is an incredibly efficient cash-generating machine.
Which transitions us perfectly into how the executive team is interpreting all this momentum. Because a company can report a pristine historical quarter, but institutional capital really only cares about the forward visibility.
What's coming next?
Right. Let's pivot to management guidance. This is the section of the call where leadership provides Wall Street with their financial projections for the remainder of 2026.
And the signal management sent here was unambiguous.
Yeah, they raised their full-year guidance across every single major financial metric.
Upward guidance revisions are heavily scrutinized by analysts, right? Because they represent a public commitment by management to outperform their own prior expectations.
You don't do that unless you're sure.
Exactly. It indicates a very high degree of operational visibility and confidence in the macro environment.
The specific revisions are pretty substantial, too. They increased their full-year revenue guidance by $28 million at the midpoint. So that establishes a new target range of $1.92 billion to $1.93 billion for 2026.
Nearing $2 billion.
Yeah. Adjusted EBITDA guidance was raised by $8 million, bringing the expected operating profit to between $593 million and $599 million. Furthermore, they increased their earnings per share target by 3 cents, guiding to a new range of $2.04 to $2.10 per share.
And the nuance within this upward revision is important to point out. Management was very transparent that this raised guidance is a hybrid result.
What do you mean by hybrid?
Well, it reflects both the fundamental acceleration of the core business, the AI efficiencies, and the digital scaling we just discussed, as well as a more favorable outlook on foreign currency exchange rates.
Oh, I see. So the engine is running hotter, and the river current has also shifted slightly in their favor.
Precisely. The combined effect is a projection of 4 to 5% total enrollment growth, which will push the aggregate student population to a staggering 518,000 to 523,000 students by the end of the year.
I want to isolate that EBITDA projection for a moment. They are forecasting nearly $600 million in adjusted operating profit for the year.
Which is a massive pool of capital.
It is. And for you, the retail investor listening to this, the most critical question you must ask when a company generates that level of profit is, what is the philosophy of capital allocation?
How do they spend it?
Right. How does the board of directors choose to deploy that wealth?
Capital allocation is the ultimate litmus test of management's alignment with shareholders. Because when a business generates $600 million, the executive team has multiple pathways, right?
Yeah.
They could aggressively expand their physical footprint, building dozens of new campuses. They could attempt to acquire competing universities, engaging in risky mergers and acquisitions. They could just hoard the cash in low-yield treasury bonds. Or they can systematically return that capital to the people who actually own the company.
The shareholders. And Laureate's management team is sending a very clear, unambiguous signal with their capital. They are aggressively prioritizing shareholder returns.
And the specific metric that dictates their ability to do this is their cash conversion rate. During the call, management highlighted their expectation of achieving an unlevered free cash flow conversion rate of approximately 50% relative to their adjusted EBITDA.
I really want to break down the mechanics of that 50% conversion rate, because it is remarkably high for a business with a physical component.
Yes.
If I am interpreting this correctly, they are stating that for every dollar of theoretical accounting-based operating profit they generate, 50 cents is translated into unencumbered liquid cash deposited directly into the company's bank accounts. Is it truly that efficient? Or are there hidden capital traps in the working capital?
No, it is genuinely that efficient. And the reason points directly back to our earlier discussion on CapEx.
The concrete versus cloud servers.
Exactly. Many traditional businesses, manufacturing, retail, even legacy higher education, can report massive EBITDA figures on their income statement, but their actual cash flow is abysmal.
Because it's tied up.
Right. Their profit is entirely trapped in unsold inventory, unpaid accounts receivable, or the constant need to reinvest capital just to maintain their aging physical equipment.
They have to spend the profit just to keep running.
Exactly. But Laureate has largely bypassed those capital traps. Because their highest growth segment is the digital, fully online product, their maintenance capital expenditure is extraordinarily low. They don't have physical inventory sitting in a warehouse.
Right.
Therefore, their paper profit converts to liquid cash at a much higher velocity than a traditional enterprise.
So on $600 million of projected EBITDA, they are anticipating roughly $300 million of pure, unrestricted free cash flow this year.
Yes.
And the Q2 transcript reveals exactly how they are deploying it. They are executing share buybacks at a furious pace.
Furious is the right word.
The data shows they have already repurchased $181 million of their own stock in the first 6 months of 2026. Furthermore, they announced on this call that the board of directors has authorized a fresh $150 million tranche for future repurchases.
Now, the mechanics of a share repurchase program are one of the most reliable engines of compound wealth creation for the retail investor, yet they are so often misunderstood.
Explain the mechanics for us.
Well, when Laureate takes its free cash flow, goes into the open market, buys its own shares, and permanently retires them, they are systematically shrinking the total supply of the company's equity.
Let me conceptualize this through a different lens for the listeners. Think of share buybacks like the dynamics of the fine art market.
Yeah, I like this.
Imagine a renowned artist creates a limited run of 100 original portraits. The market values each portrait based on the total supply of 100.
Right.
Now imagine a wealthy collector systematically buys 50 of those portraits and locks them in a vault, permanently removing them from circulation.
So now there's only 50 left.
Exactly. The remaining 50 portraits suddenly become vastly more scarce. The inherent value of the artist's work hasn't changed at all, but the scarcity of the available supply drives the price of the remaining portraits significantly higher.
That is exactly the mechanism. By retiring $181 million worth of stock and authorizing another $150 million, Laureate is aggressively locking those portraits in the vault.
As a retail investor holding shares, you don't have to lift a finger or invest a single extra dollar. Your specific percentage of ownership in the total company automatically increases because the denominator, the total number of outstanding shares, is shrinking.
And this is actually the mathematical driver behind the increase in their earnings per share guidance. The absolute earnings are growing, yes, but they are also being divided among fewer total share.
It's a double tailwind for EPS.
Exactly.
However, a critical analyst must recognize that a company can only sustain an aggressive share repurchase program if their underlying balance sheet is structurally sound.
That is vital, yes.
If a company is over-leveraged, their creditors, the banks and bondholders, will eventually enforce restrictive covenants, forcing management to divert that free cash flow away from buybacks and toward debt service. So we need to evaluate Laureate's leverage.
And the balance sheet data provided in the Q2 transcript reveals what institutional analysts refer to as a fortress balance sheet.
Fortress?
As of June 30th, 2026, Laureate reported a net debt position of merely $61 million.
Let's deconstruct that figure for clarity. They carry a gross debt load of $223 million, but they are simultaneously holding $162 million in liquid cash equivalents.
Right.
So if they chose to deploy that cash tomorrow to pay down the principal, the remaining obligation would only be $61 million.
And when you juxtapose a $61 million net debt position against a business generating nearly $600 million in annual operating profit,
it's nothing.
The leverage ratio is effectively zero. It is a rounding error. They are essentially operating a debt-free enterprise. This total absence of leverage is what provides them with absolute financial sovereignty. They have no restrictive covenants choking their cash flow. They have the internal liquidity to self-fund any necessary technological upgrades, weather unforeseen macroeconomic shocks, and still sustain massive capital returns to the shareholders.
The confluence of these factors brings us to the ultimate synthesis of this deep dive.
The bottom line.
Right. We have analyzed the massive operational scale. We have deconstructed the margin dynamics of the digital pivot. We have evaluated the AI integration, the guidance upgrades, and the fortress balance sheet enabling these heavy buybacks.
We've covered a lot of ground.
We have. And it is time to deliver the bottom line. We promised an actionable, opinionated takeaway on Laureate Education.
The internal data presents a highly compelling structural advantage.
Based on the mechanics we've unpacked today, I take a firmly bullish stance on the fundamental trajectory of LEUR for the retail investor.
I agree.
Now, it's crucial to state that this is an analytical perspective, not personalized financial advice. Rigorous independent research is always required. But the operational thesis is incredibly strong.
It really is.
If your portfolio strategy seeks an asset characterized by high-margin digital expansion, near-zero capex requirements, aggressive and sustainable share repurchases, and a pristine balance sheet, Laureate is signaling immense operational strength. The internal machinery of the business is exceptionally well calibrated.
The internal machinery is indeed pristine, but a critical analysis demands that we look beyond the walls of the company.
Right.
Because a perfectly calibrated engine will still fail if the vehicle is driven off a cliff.
That's true.
We must address the macroeconomic and geopolitical environment in which Laureate operates. They are heavily concentrated in emerging markets, specifically Mexico and Peru.
And for a North American retail investor, the immediate heuristic is often to view Latin American capital deployment as inherently volatile.
Exactly. Susceptible to extreme political swings and currency crises.
The geopolitical elephants in the room. If the internal operations are so strong, the logical question is whether the macro environment of Mexico and Peru is stable enough to protect the investment over, say, a 5 to 10 year time horizon.
And the management team dedicated a significant portion of the earnings call to systematically de-risking this exact macro picture.
Let us examine Mexico first.
Okay. The dominant geopolitical variable for any multinational corporation operating in Mexico is the stability of its trade relations with the United States.
Unquestionably.
During the call, CEO Serck-Hanssen specifically addressed the status of the USMCA.
That's the United States-Mexico-Canada Agreement, which is the modernized legal framework that replaced NAFTA.
Correct. And this is a crucial point because leading up to this earnings call, there was considerable anxiety in the financial press.
Yeah, I remember seeing that. There were headlines suggesting that the trade deal was in imminent jeopardy due to a lack of consensus during a recent summit.
Exactly. But the financial media often conflates procedural milestones with structural collapse.
Happens all the time.
There was indeed a mandatory joint review of the USMCA in July, and the agreement was not officially extended during that specific session. If you only read the headlines, you would assume the free trade zone was unraveling.
Which would be catastrophic for the Mexican economy. And by extension, Laureate's middle-class consumer base.
It would be. But the CEO utilized the earnings call to clarify the actual legal mechanics of the treaty, completely diffusing the panic.
What did he say?
The absence of a consensus extension in July does not trigger the cancellation of the agreement. The legal text of the USMCA dictates that this lack of consensus simply activates an annual review mechanism that begins in 2027.
Oh, so the structural integrity of the treaty remains totally intact?
Yes. The bottom line for investors is that the existing USMCA trade agreement remains firmly in place, legally guaranteeing Mexico's reliable, tariff-free access to the United States market through the year 2036.
2036. That provides a decade-long runway of guaranteed geopolitical stability for cross-border capital investment.
And that stability is deeply anchored in physical reality, too. The CEO highlighted that Mexico has recently solidified its position as the United States' largest single trading partner.
Wow.
Citing record export levels achieved just prior to the call in May.
And a lot of that is driven by nearshoring, right?
Absolutely. The phenomenon of nearshoring, where global supply chains are aggressively relocated from Asia to North America to reduce logistical friction, has physically entrenched the integration of the U.S. and Mexican economies.
And the economic implications of nearshoring directly benefit Laureate. Because as massive manufacturing and logistical hubs are built in Mexico to supply the U.S. market, the demand for highly skilled, educated workforce skyrockets.
It creates a massive talent bottleneck.
Right. The bottleneck for nearshoring isn't just physical infrastructure, it is human capital. Laureate is perfectly positioned to provide that human capital by upskilling the exact demographic that those new industries require.
The macroeconomic engine of Mexico is secure, which ensures the continued expansion of the middle class that purchases Laureate's educational products.
But we must also evaluate their second primary market, Peru.
Right. Historically, Peru has exhibited a much higher degree of political volatility.
Yeah, they have experienced massive executive turnover, like what, 6 presidents in 6 years?
Something like that, yeah. Along with significant civil unrest. And that level of instability rightfully makes capital markets nervous.
It introduces a heavy risk premium to any asset located there.
So how did management address the Peruvian volatility on the call?
The transcript provided a vital, real-time update on the institutional reality in Peru. Management's thesis is that the macro outlook has stabilized significantly in the wake of the recent national elections. Specifically, they pointed to the election of President Keiko Fujimori.
Now, to be absolutely clear for our listeners, our analysis here is strictly economic. We are not evaluating the political ideology of the administration. We are solely examining how capital markets and corporate management interpret the policy signals.
Exactly. From a purely capital markets perspective, management's view is that the incoming administration is prioritizing a heavily market-oriented agenda. And in the context of emerging markets, a market-oriented framework generally signals a commitment to predictable regulatory environments, the protection of property rights, and the facilitation of foreign direct investment.
Right. Management's explicit thesis on the call is that this policy direction will rapidly strengthen general business confidence, encourage long-term private capital deployment, and support broader macroeconomic growth across Peru.
The period of extreme institutional chaos that deterred foreign investment appears to be receding,
replacing the risk premium with a predictable runway for Laureate to execute its Peruvian expansion.
So, with the macro environments in both core countries effectively de-risked, management is turning their focus back to internal optimization.
And this is where CFO Rick Buskirk highlighted a really fascinating inefficiency that they are actively targeting.
Oh yeah, the margin gap.
Right. Currently, Laureate owns the vast majority of its physical real estate in Peru. However, in Mexico, they operate primarily on leased real estate. Because of this structural difference in property ownership, there is currently a 6% gap in rent-adjusted margins between the two countries, with Mexico lagging behind.
A 6% margin drag is massive at this scale.
It is. But management views it as an opportunity. They explicitly stated their strategic intention to close a substantial portion of that 6% gap over the next 3 to 5 years.
How are they going to do that?
They plan to achieve this through the aggressive implementation of centralized shared service cost structures across both nations, and by leveraging the extreme profitability of the expanding digital business we discussed earlier.
They're targeting 30 basis points.
Yes. They are formally targeting at least 30 basis points of consolidated margin expansion every single year.
So when you aggregate all this data, the investment thesis becomes exceptionally clear. The macro environment in Mexico is legally anchored by trade agreements through 2036. The institutional environment in Peru is signaling stabilization and an influx of private capital.
And internally, the business is scaling a digital product with astronomical ROIC.
They're protecting their legacy revenues, they're deploying predictive AI to collapse acquisition costs, and utilizing a pristine balance sheet to permanently retire shares.
The runway for continuous value creation is remarkably unobstructed.
It is rare to see the internal operational execution align so perfectly with the external macroeconomic tailwinds.
Very rare.
Which brings us to the conclusion of our analysis. We've dismantled the corporate jargon, we've evaluated the mechanics of the digital pivot, we've analyzed the capital allocation strategy, and we've established a data-driven bottom line on LAUR.
It's been a deep one.
But before we close this deep dive, I want to leave you with one final provocative concept. Something to consider as you evaluate the broader structural shifts in the global economy.
Let's hear it.
Throughout this deep dive, we have meticulously detailed how Laureate Education has perfected a high-margin, fully online, AI-supported educational model.
Right.
They built this highly efficient machinery in Latin America, primarily because the traditional university participation rate in those emerging markets is incredibly low. For context, only 36% of the eligible population in Mexico participates in higher education, compared to the mid-60s in the United States.
So there was a massive void.
Exactly. Laureate identified a massive structural void and filled it with an accessible, digitized product. But I want you to pivot your perspective and look at the domestic reality in the United States.
It's a completely different landscape.
We are currently experiencing an unprecedented crisis in higher education. The traditional U.S. university system has become bloated, bureaucratically paralyzed, and just financially ruinous.
Oh, absolutely.
College tuition costs are spiraling completely out of control, generating a student debt crisis that is actively crippling the economic mobility of an entire generation. For the average American working adult, returning to school to upskill is increasingly viewed as an impossible financial risk.
That's just too expensive.
So here's the fundamental question. If a corporation like Laureate has empirically proven that it is possible to deliver high-quality, fully accredited AI-supported degree programs at a 40% discount to traditional models, while simultaneously generating mid-50% profit margins and hundreds of millions in free cash flow, how long until this ruthless, digitally efficient architecture turns its sights northward?
That is a fascinating thought.
Could an asynchronous, lower-cost, structurally optimized model like Laureate's eventually become the exact mechanism that disrupts and collapses the bloated legacy higher education system in the United States?
It's definitely a structural vulnerability worth pondering.
Thank you for joining us on this Talk Takers Deep Dive. Keep monitoring the data, keep questioning the institutional narratives, and always stay curious.